Hello, everyone, and welcome to our first quarter housing outlook. Today's focus is on Southern California. I'm Ali Wolf, Zonda's chief economist, and I'm pleased to be joined today by Steve Carr. Steve is Zonda's senior vice president of advisory and Southern California expert. Before we begin, please note that we will be sending you the recording within 24 hours in case you missed anything or want to rewatch. Please also feel welcome to submit questions at any time. Time permitting, we'll address them live today. As mentioned, we are Zonda, a housing data and consultancy firm. We track the entire building lifecycle from raw land up until the building out of new home communities. Zonda is not only the largest new residential data provider in North America, but we are also focused on strategy. Our advisory team, led by Tim Sullivan, runs custom market studies across the country, ranging from pricing and absorption analysis to mixed-use studies and built-to-rent research. The data behind our research can be analyzed in Enterprise. Enterprise 2.0 is now available, where you'll find all of our sales and supply stats, but also master plan community profiles and monthly market reports for the top 100 housing markets across the country. We also have Zonda Virtual, a way to upgrade your buyer's journey through innovations like virtual reality and interactive site maps. If you'd like to learn more, please visit zondahome.com/virtual. Livable is another key piece for connecting consumers with the new home construction industry. Livable's free-to-list listing platform will leverage Zonda Virtual's engagement solutions, engaging editorial, and Zonda's proprietary real-time market data to provide the most accurate, approachable, and engaging home buying experience. Coming in spring 2023. Finally, come see us in person. We have events all throughout the country this year, including Builder 100, our Deal Maker series, and our rental forecasts. We would love to see you there. Now with that, today's agenda will be broken into two core parts. I'll start with the national trends before I bring in Steve to break down the stats we have for Southern California. Now, where I want to start with my section today is that a lot of you joined us last week for our housing market update. And I wanted to make this presentation a little bit different, but I also felt if you weren't able to join us last week, I needed to start in the same place, which is just looking at the market that we're in today, where we're looking at rates that have just over 12 months moved from 3% to 6%. And for consumers, there's really this adjustment period. And what I'm saying is consumers are working through the 5 stages of grief of going from a 3% interest rate to 6%, of in the past being able to afford a $700,000 home, for example, and not making any changing to their budget. They're now looking at the $500,000 price point. If you look at the monthly payment, and you look here in Southern California, we're looking at a 40 to almost 50% change in that monthly payment over 1 year's time. But there's an interesting dynamic where I really never thought I would celebrate interest rates being at 6%. But what we've seen is rates went from 3 to 7, and now we've had 10 consecutive weeks with rates under 7%. Which for some consumers is offering a little bit of stability. At least you're not kind of chasing the market. At least you have a sense of where rates are right now. Now, one of the things that we wanted to know and we've been tracking is how have consumers responded to rates being in the 6s versus the 7s? And if you look at this, these are the preliminary results from our division president survey collected through yesterday. And what we're seeing for January is we have almost 50% of builders that are now saying that consumers are responding positively to rates coming down because, as some of the comments say, every little bit helps, or confidence is slowly growing, especially because of the existence of incentives and price cuts that we'll talk about throughout this presentation. But as you step back and you look at the market, what we're finding, and most of you probably saw this morning, we released our new home market update report. that showed that December national new home sales were down 40% compared to last year. Now, this is according to our pending sales index, our PSI. As Steve shows his data later, you're going to find that some of the numbers are a little bit different just because of different methodologies. But look at the December, how we finished the month, a little bit of a month-over-month uptick. That's in December, and at least some of the early feedback that we're hearing for January is partly seasonal, but also partly seeing a little bit of an uptick in the market across many areas in the country right now. Now, that December month-over-month uptick, we've also seen that in the Southern California markets. Year over year, you're seeing the index is showing sales down between 50 and 60% year over year. Now, think about it. In the context of Southern California, we historically have had an outsized impact from higher rates. We have higher base prices, so that change in the monthly payment is greater. But as Steve will talk about, when you look at the supply stats, we're also in a unique position in Southern California relative to most other markets, because those supply constraints are even more dire than what you're finding in areas that have more developable land. Now, as we look at that and compare what's happening in the national market with California again, one of the things that we like to look at is not only sales, but what's happening with cancellations. Now, know that this is self-reported, and the data here I'm showing you is through December. Steve's going to talk about data, I think, through the first couple of weeks of January. But what we found is that the cancellation rate in California is roughly in line with the national cancellation rate at about 20%. Now, a big follow-up question, and most of you have heard me ask this before, is, well, what happens once there's a cancellation? Now, I was in Florida last week with Christine Smale, our Florida expert, and as her and I were talking to builders and looking at data, we found in that market, the majority of builders were saying it wasn't that hard to resell a home. But if you look at the national trends, and if you look at California, we're finding the majority of builders are saying it's difficult to resell a home, at least not without some kind of adjustment. And here at Zonda, we're able to track incentives across the country. And as you look at Southern California, we have in San Diego the highest share of communities that are offering incentives, but the smallest percentage of the overall list price at 1.9%. If you look at LA and Orange County, we have 68% of all communities that are offering incentives, with an almost 4% of the overall list price in terms of that dollar amount. As we look at the incentives, we're trying to make sense of what kind of incentives are out there and what incentives are the most effective. And what we have found over time is it is those mortgage rate buy downs that help adjust for the affordability backdrop that usually are the most effective to consumers. Now, we've seen a lot of adjustable rate, kind of teaser rate with the lower rate and then going up over the next few years. We know that those are available, but we also know there's an increasing issuance of those fixed rate buy downs. And what we're finding in our data is nearly 60% of builders are offering rates from the mid 4s to the low 5s right now. So again, headline at about 6. Consumers that are actively shopping can sometimes get rates in the 4s. Those are expensive, to the tune of what I've heard is between $20,000 and $70,000. So those don't come easily, but we know that for consumers, they're saying, well, I wanted to buy, but then those rates went up and that's kind of changed the math. What we're also tracking is what's happening with pricing. Now, on a national level for December, 56% of builders kept their prices flat, 40% lowered. That was 50% in California for December. And as we're tracking this, we know that dropping prices does pose a risk to backlog, poses some cancellation risk, but we also know we're working through some of the backlog. And we also know from talking to some builders, they're proactively going back to the consumers in backlog to ensure that whatever happens, they want to go through with the purchase. But when you look at the price cuts, it's also a really important opportunity to fill the pipeline, because there are so many consumers that are saying, I want to buy, but I'm waiting for prices to drop, or I'm waiting until I don't feel like I'm buying at the top anymore. Most of you have heard us use the phrase FOBAT, fear of buying at the top. And when you look at the market, what we're finding is this very quick rush to price discovery. What we've been saying to our clients is just rip the Band-Aid off. Don't do little cuts. Just do a cut that helps you find the market quickly. Because once consumers feel like they're getting a deal, that overcomes that mental threshold of fear of buying at the top. And what we're finding right now is roughly 70% of builders have lowered prices over the past handful of months. And we have 40% of which that are saying their prices are down between 5 and 15% compared to, again, just the peak levels that we've seen. So as we're tracking this and we're seeing this increased willingness to offer the incentives and increased willingness to make changes to home prices, we're finding that so far January, again, data through yesterday, January is showing an uptick. What we have is that about 60% of builders are saying that their sales are up from January relative to December. We have about 30% that's saying their sales are flat. Now we'll step back and we have to acknowledge when you go from January to December, this could be just a pure seasonality bounce. You would see this, you would expect this. We are just coming off of traditionally the slowest times for the housing market anyways. As we're looking at increased in contract sales and tracking increased traffic, the majority of builders that we're talking to are saying that they're seeing that bounce, they're seeing a little bit more activity, but we're still way below the levels that we were in the past few years, with some exceptions. We have 40% of builders that we're talking to that are saying that their sales and traffic are stronger than they expected for January. And I've talked to some builders, particularly in the Southeast, that are saying this January is already looking better than what they saw for last January. So traffic, I think we can acknowledge it's up partly because of seasonality. I think it's up partly because of that acceptance. Again, we've kind of gone from mourning to acceptance of rates, especially when those other discounts are available. Now, there's this interesting dynamic where the new home market is offering these compelling options based on everything we talked about related to pricing, but also that the new home market is near a record high in terms of the overall share of inventory. For people that are looking to shop right now, you're finding that the resale market is still pretty constrained. We are going to watch resale, though, for what happens over the next few months. We know that a record number of people have delisted their homes towards the end of last year. Are they delisting because they want to stay put? Or are they delisting because they're trying to time the market? We're going to track that with overall inventory, but we know right now that the new home market is in a really unique and good position. But we have another challenge. Besides everything that we've talked about with affordability and confidence, there's also data that says in 95% of counties across the US, renting is more affordable than owning. This is a challenge because we're working against this affordability constraint where, yes, the rental market is softening a bit, and we've seen a lot of rental growth, but still, if you compare those payments, you're finding the rental market offers that value equation. With a bit of a caveat. So most of you know we do an annual millennial survey. And one of the questions that I asked this year is, are you willing to pay more for a mortgage payment than your current rent? And if yes, how much? You can see almost 25% of our respondents are saying, yes, I would pay $500 more every month to buy a home. 15% are saying, yeah, $300 more a month. For us, I think the way you view this is that desire for home ownership is strong. There's still okay, I'll pay more, but I'm paying to myself and I'm building wealth over time. Hindsight is 2020 though. I asked this question, are you willing to? I didn't ask this question, are you able to? And so I think that don't rest too much on these numbers and say, okay, well, this means people are going to put all this money towards. I think we need to then kind of ask the question of, are you able to do that? But as we're looking at this, and as the market has evolved, what's happened, and many of you have probably used the phrase or heard the phrase, we've gone from taking orders back to selling. We came from this really hot, really energized market, and now it's just a little bit harder to get those sales. And from our opinion at Zonda, consumer research is more important than ever. And we have teams here at Zonda that are looking at consumer research and are doing custom studies, but just high level. Again, if you look at our millennial survey, we asked a question about what are some of the components that are high priorities in your next home? And the answer, if you sum it up, it's storage, it's some private space, and it's some socializing space, some pretty basic answers about what really matters. And then what about where we live? Well, you can break this out because we know the answer will be a little bit different for people that have kids versus don't have kids. But if you look at the overall ranking, it's still that accessibility and it's still safety. Walkability is obviously a plus, but walkability drops off for those that have kids versus those that don't have kids. But that, when you look at the cumulative results, are telling you some of the things that are really high priorities for consumers. As we're looking at the market, though, we know that there has been this adjustment where there's been a bit of a buildup of the QMIs, not really in Southern California to the same extent as most other markets, but you are seeing that starts are coming down, partly because the speculative home building has gotten pulled back, and partly just realigning starts with sales. What we're finding nationally and in California is the majority of builders are expecting starts to be lower in 2023 compared to 2022. In California, it's 70% of builders that expect their starts to be down, 20% flat, 10% expect those starts to be up. Now we're tracking this. We're tracking to see that seasonality component. We're tracking the price elasticity to see how much sales do come back in response to some of the changes on the ground. But that's the key thing that we're watching, is that starts are expected to continue to pull back. And then there's a question. Well, if you have fewer starts, does that mean we should expect to see fewer constraints? And at least what we're seeing right now, and this is, I think, the positive sign of everything that's changing and turning, is we now have 77% of builders that are saying they're seeing some kind of improvement in building material costs. For those that are saying they're not seeing an increase in cost, they're at least saying that we're not seeing this rapidity of how quickly these prices are going up. But I think the comments are really interesting, where key inputs are still challenging, in some cases windows, in some cases appliances, but also the idea that in general, the supply disruptions are at least trending in the right direction. And you hear this qualitatively and you see this quantitatively in the data. Producer Price Index, the PPI. You can look at the costs of these materials of different sectors. What you're looking at here is the PPI for construction materials. We went through a period, look where that plus 35% is, and look at how long that period is. It's over a year, where we were talking a year-over-year change of 25, 30, 35%, where these costs were going up and up and up, and we couldn't get our hands on the materials. We know that that's still happening for some factors, but look at that minus 2.4%. Finally seeing a little bit of a rollover on these construction materials, with a caveat. The way you should think about this is that the costs have gone up, and now a slight rollover. So it means we're nowhere near the cost we were in 2019 or early 2020, but we're not seeing as much growth, which matches in line with just national inflation figures as well. When you think about construction materials, you also want to think about labor. And I will say for the past 2 to 3 months is the first time I've really heard of any comments of the labor market having any kind of slack. And it really comes down to, is it the front end trades or the back end trades, or the front end suppliers or the back end suppliers? Because the front end have worked through some of those starts and are feeling like the market's a little bit different, where the back end is still seeing kind of full steam ahead, everything is going because they're working through the backlog of those homes. It's an important thing to distinguish against, which is those two different categories. Now, as we look at this, and we capture that seasonal rebound, we capture that acceptance, we capture that price elasticity. Anyone that knows me knows that I also need to say, but don't say game over just yet. We still have some of those lingering economic concerns related to the policy changes that we're seeing on the national scale. And if you look at comments, most of you know we still think a run-of-the-mill recession is likely. So does the World Bank. So does the International Monetary Fund. We're also seeing banks of big CEOs of big banks also planning accordingly as well. At least consensus as it stands today is it is more of a mild recession that is not that long-lived, which is hard for us to, I think, remember what a normal recession looks like when you have the COVID recession and you have the great financial crisis as the two most recent examples. As we're looking at all of this, we're trying to plan for the near term, we're trying to plan for the medium term. And again, going back to our millennial survey, we have the largest amount of millennials that want to buy a home over the next 1 to 3 years that we've seen in our 6 years of doing the survey. To me, this is the idea that there were a lot of really qualified, higher wealth, pristine credit score individuals that bought over the past few years. And then there's this pool of people that weren't able to step in or are still interested. And so trying to plan for that, but also thinking about those market differences. And I think from a national headline point of view, there's a lot of jokes about California, and you do see that there's the more people moving out than moving in with the net migration stats. But I think a lot of that comes down to what we've seen with overall affordability. And as we go back to our millennial survey, one of the questions that we asked is, if money wasn't an object, where would you live in the US? And 4 of our top 5 responses continue to be California, San Francisco, LA, and San Diego. So I think as we think about the longer term desirability and viability, I think to me, this is supportive of future strength. So with that, I am excited to bring in Steve Carr. As I mentioned, he is our Senior Vice President of Advisory, and Steve's going to go through the Southern California market trends. Now, before I pass it to Steve, just real quick, for those of you that don't know him, Steve is born and raised in California and has moved around a lot, from the Central Valley to Orange County, back to San Mateo, to San Diego, back to the Bay Area, and back to San Diego. Steve has 30 plus years of experience in real estate covering California. And as we're looking at the trends and we're looking at the shifts, there's really no one better to talk to you about those trends. So Steve, let me pass it to you.
Thank you, Ali, very much. I actually, unfortunately, my hometown was in the news all day yesterday. I grew up in Half Moon Bay, so unfortunately the shooting was not welcome news, but hopefully we'll just focus on Southern California today. What I'll talk about first is the definitions of each of the markets that we're going to talk about. First, I'm going to go over the Southern California market overall, which includes all 3 MSAs combined. That includes Los Angeles, Anaheim MSA, Riverside, San Bernardino, and San Diego, Carlsbad MSA. Now, through the presentation, I will most likely refer to Riverside at several points to the Inland Empire. That's typically the words that we use to describe the area. And just so you know, if you happen to be outside of California, that huge green space there is largely desert. So really, we're only talking about kind of that western portion. So if you drew kind of a diagonal line from the upper right corner of Los Angeles, Anaheim, down to the upper right corner of San Diego, Carlsbad, that's kind of the bulk of the Riverside, San Bernardino marketplace. Overall, this represents 21 million residents, 7.5 million housing units. And just a fun fact, that's about 6.3% of the US population lives in Southern California. Now, over the past year, we've had significant job gains in each of the MSAs. Riverside, San Bernardino grew by 90,000, Los Angeles, Anaheim over 300,000, San Diego, Carlsbad 76,000. That's great news. It helps buoy that consumer confidence. Moving forward, unfortunately, we're going to see some cuts. We're basically at full employment, so it's hard to sustain the rates of growth that we're seeing right now. So moving forward into 2023, we're going to see all these rates basically cut in half, if not more. Now, if you look at the overall employment picture by industry, you can see a large part of that growth is in the leisure and hospitality market, education and health services. Obviously, not all of these you'll see as we move through the presentation and the prices that are achieved here in Southern California. A large segment of this job growth aren't actually our target market for the home building industry. In fact, we still look at the employment growth to permit ratio, but it's more for trending. It used to be kind of a 1-to-1 ratio, and that's out the door just because our prices have reached a point where that ratio just does not make any sense anymore. So you may have heard years ago of the jobless recovery. we're essentially we're largely untethered from kind of the job growth. It has to be generally positive, but the numbers and the giant numbers don't always make a significant impact to housing demand. There are kind of 4 headline trends that I just want to let you know about for Southern California and California in general. We're at full employment. Anything less than 5% is generally considered full employment. Ali may have a different view, but that's what I was taught in school. So, we expect, that the employment picture is pretty much at its capacity overall for 2022, and with potential additional growth in 2023, it's good news. There's definitely a worker shortage being felt in multiple job sectors. There's some bioscience companies in the LA basin that really are trying to address worker shortages. There's some clouds on the horizon, though. Google, Microsoft, all the layoffs we've been hearing about could potentially kind of undermine some of this consumer confidence. Although Google doesn't have a gigantic presence in LA, Orange County, it could impact a couple hundred people. And then what's interesting is Disney's new CEO indicated that employees had to return to work in the office at least 4 days a week because they're a creative company, and he feels that there's a need for people to be together to be creative in their industry. So it'll be interesting to see how the tertiary markets really respond, and if this becomes a growing trend. There definitely is traffic everywhere, typical of Southern California. But it was really nice during the pandemic for a while when all that subsided. But if workers are forced to go back into the office for more than 3 days a week, that will definitely impact where they'll look for a new home. Now, active new home communities, just to kind of give you a visual of how the market looks overall. Unfortunately, I had to cut the map off. So the little portion on the right represents the very top end of the marketplace, the northern portion. But there's 2 colors here. Purple are single family detached communities, and the green are attached. And you can see that the coastal markets, Los Angeles, Long Beach, Irvine, Oceanside, San Diego, they're largely becoming attached communities. We really don't have the land supply to support any sort of large scale. There's a few master plan communities here and there, but for the most part, density is really the name of the game in Southern California. And it's rare to have lot sizes over 6,000 square feet. And I'll show you some well-executed small lot product later in the presentation. Now, Ali mentioned our community count and supply side constraints, which have really helped this marketplace in the last 6 months through these changes. So you can see on the graph on the bottom left, the number of active communities. So back in 2019, we reached a high of about 740 active new home communities in Southern California. Fast forward to January 2023, and we're sitting at about 425 new home communities. So you can see there's a lot less supply in the marketplace, which has helped with competitive forces. There isn't as much vacant land, developed land in the marketplace. So it's a very different situation compared to the prior cycle, where we had almost double the amount of active new home communities and big impacts into the number of homes that needed to be sold. Then on the right, you can kind of see I'll give you an overview of our price levels. Red is anything over 1.5 million. The green or teal is 750 to 1.5, and then the purple is less than 750. So you can see that really the heart and affordability portion of our marketplace is in San Bernardino, Riverside County. The coastal markets are typically very high priced, and if you're getting a lower price, it's typically attached or very high density detached. So sales volume. So for the overall marketplace, you can see 2020 year to date, our numbers are still being finalized, but it looks like we're going to have somewhere in the neighborhood of 16,500 new home sales for 2022. That's down from obviously the heightened demand levels in 2020 and 2021. Again, the fewer number of communities is really helping out in this situation. We anticipate that moving forward, given that the first half of 2022 was actually pretty good and the back half of 2022 was bad, we think with a more normalized marketplace under current conditions, that these sales will probably diminish again, maybe another 10%. And again, that differs a little bit from what Ali's projection was, but we're kind of looking at different samples. Sales concentration, Riverside, San Bernardino represents about 54% of the market. LA, San Diego, just a fraction of that. So again, Riverside, San Bernardino is really where the action's been at. I think as prices start to come down, we may see some pullback in people going a little less farther out and help buoy some of those San Diego, LA sales as long as they can afford those prices. Now we track weekly sales and cancellation trends. And I think there was a question earlier about what is a cancellation. A cancellation in our view is basically a contract that was written that was canceled prior to closing. So you can see on the right, we have in January a strong decline in cancellation rate. We're going from about that 20% rate to 10%. Great sign where, again, as Ali mentioned, buyers are kind of coming off the fence. We've had low interest rates. There's a little bit more confidence in the market. Nobody wants to buy at the top, but if our pricing remains relatively constant, they're getting a good deal. Obviously, incentives have to be thrown into that. Then they'll come off the fence and purchase. And then on the left side, net contracts, which are contract sales for the week minus cancellations. We've had the strongest January in a while. The most recent week is the best we've seen in Southern California since June of last year. Average sales per project. I think what you're going to see throughout the presentation, Ali had a few graphs. We've definitely had a hook in the marketplace here. So we kind of hit the bottom in December and we're kind of coming out of it. But again, moving forward, we're probably going to see some unevenness in the market. We're going to see good months, bad months. It's definitely going to bounce around moving forward. But we've gone from super heightened rates of, typically between 4.5 and 6 sales per month across the market area to a more normal level of 2.5 to 3 per month. So you can see while it hurts to go from 5 to 2.5, if you look at the history, that's more of a normalized marketplace. And really, so we kind of have to separate the abnormal from the normal, even though it's painful. Price increases. Now, this chart you have to take with a little grain of salt because it includes both attached and detached. It is just the base asking price of all new home sales. And again, because inventory tends to be low, especially in a market like San Diego, the trending isn't always really what's reflected in the marketplace. San Diego in particular had a strong pullback in the number of active projects and where those projects were located. So even though it kind of showed a dip in 2021, there was really no dip in the marketplace. It was really going higher overall. It was just a shift to higher density and lower priced products. And on the opposite end of that, Los Angeles, Orange County have very high priced communities out there. We are tracking apartments that go up to $20 million plus. So that kind of increases that trend line. Quick move in, Ali mentioned. Really what we're seeing is that our quick move in inventory is definitely increased. You can see that the bite that the pandemic took out of there, but we're back to kind of the 2018 to 2019 marketplace. So again, we haven't swung the pendulum so far that we're in a situation that we're going to experience free falling prices. And just to illustrate that, so back at the previous market high model, there were over 3,500 models built and actively selling, 35 individual models, I should say. And currently we're at less than 1,000. So a huge difference there. And the market average is closer to 2,000. So again, our inventory and our vacant lots on the right, you can see in the previous market high, which was 2007, there were over 40,000 vacant and developed lots in actively selling communities. We're obviously 58% below that currently and under 20,000 units. So that really balances out that marketplace, where in like a market like Phoenix, where you have more unconstrained land supply, there's much more competition. There was a lot more opportunity to build large scale communities. That doesn't happen here in Southern California. And the distribution of vacant lots, again, those coastal constraints, so Los Angeles, Orange, and San Diego represent, 35–40% of the market, and the rest of it is Riverside, San Bernardino, and we'll get into that a little later. So let's start and look at Los Angeles and Orange County, and we'll kind of go through similar slides and kind of show the differences on with the quick move in, what the resale market's doing, and how prices are reacting. So Los Angeles, Anaheim is by far the largest in terms of population and households in Southern California, with 13.2 million residents and 4.5 million households. Much of that increase in leisure and hospitality was located in LA, Orange County, and also the education health services. But higher paying jobs such as professional business services and information are also doing quite well. So our starts are lagging closings, which is great. We're managing the market pretty well. So we're not seeing a period where starts exceed sales significantly, which would potentially signal some potential oversupply coming. But we're doing a good job of managing the starts and closings. Community count, much like the overall market, you can see a very similar trend. We're about 155 active new communities currently compared to 300. So about a 50% difference from 2019 to current. The graph on the right, or the map on the right, shows the price differential. That heavy red section around Los Angeles represents attached communities primarily, and they're all over 1.5. And the circled areas really represent the depth of our future lot supply. So it's really centered in specific master plan communities throughout LA and Orange County. And I think moving forward, the communities that are kind of standalone infill really have an opportunity to perform a little bit better, just in terms of less competition. So you're not competing with, a public builder down the street that's offering $40,000, $50,000 in incentives. You get to kind of set your market against the resale market. Sales rates are equalizing. We saw this earlier in Southern California overall, but again, they're very similar just in terms of we're about 2.6 to 2.7 sales per month on average per project. Again, it's not as high as it was, but it's not as bad as it's been. So we just have to bear with that. I know that forecasts were done based on kind of heightened market demand, and now we have to figure out how we kind of build that and create a more equilibrium just in terms of our expectations moving forward. Orange County is the highest priced new home market for a detached home. So a new home reached a peak of about 1.9 asking in the summer of spring, summer of 2022, and has been on the decline here more recently. And the good thing that's helping us prop up is that inventory that we've been talking about. The one thing that I want to mention here is, and Ali mentioned it before, is incentives are prevalent in the marketplace, and the incentives that Ali was mentioning is it really go towards kind of future unbuilt product. Anything with a quick move in, it has much higher incentives currently. Pretty much the top 3 public or 4 public builders were all offering specials in January, move-in specials for quick move-in homes. Those specials, were definitely in the anywhere from 30,000 to, I've seen them as high as 60, 75,000 as well. So, incentives are prevalent. They're not necessarily considered in this graph, but they're out there. Quick move-ins, similar situation. The good news is that we really only have 1.5 months of quick, or actually 1.5 unit per project on average of quick move-ins. So overall, there may be obviously projects that are having a little bit more difficulty with quick move-ins, but from a market standpoint, 1.5 is not out of the ordinary for this marketplace. In fact, it's pretty near normal for the overall time sequence. And if you look at the gray line there, is largely under the period from 2018 to 2020. Now the resale market, again, we're seeing shifts in the resale market like we're seeing in the new home market. From peak, LA County, I think, is down about $150,000. Orange County, I think, was about the same as well. The good news is Orange County median home prices increased each month since November. Hopefully January will continue the same trend that it's on. Original asking price, so the percent of original asking that these homes are getting are generally between 90 and 95%. So the resale market is discounted in LA County about 10% typically, a little bit less, so about 92% in Orange County. So, in our discussions with home builders, we're typically hearing that 5% plus for incentives. It's also being reflected in the resale market. Days on market definitely up, but again, not at levels that we haven't experienced before. Vacant developed lots. This is the amount of lots that are currently not developed in active projects. So again, we have about a year's worth of supply, which is not abnormal for the market. If you go back to 2012, we had over 25 months of supply. So over 2 years of supply at that point. So we're doing pretty well on that front. Future supply, this just highlights those areas that I mentioned on the graph. We have very specific areas that future supply is concentrated in, and the balance of the market is hard geographically to find land, but if you can find land in good locations, that's where the opportunity lies. Top home builders, pretty much most of the publics are active in the LA Orange County marketplace. Lennar is the most active, and you can see with the average list prices here, we're not an affordable market by any stretch of the imagination. And if you go back to Ali's original slide, if you're talking about $1 million at 3%, your purchase price goes down to $750 or so under a 7% scenario. So these are hard prices for a lot of buyers to manage, but overall sales rates are strong throughout the top 10. And you can see anywhere from 6 to 2.5 per month on average for all these builders. So, that is aided by the fact that, many of these projects have been opened prior to 2022 or the beginning of 2022. So they have the very strong sales up front, and then they've been slowing slightly. Now, I've kind of been throwing a lot of numbers at you. I thought we'd just take a little step back here real quick. I'll highlight the Landing at Tustin Legacy, which is a Brookfield community. I mentioned before that Southern California is really a market focused on density, especially the coastal markets. This community has been very successful, and as far as I know, hasn't done any extraordinary incentives. They're currently sold out of all 3 of their product lines, but it is their Sierra collection in particular, very innovative for a detached community. They have varying lot widths and product types. So the first in the picture there, the first one's a 2-story, the second one's a 3-story. So the first one's wide and shallow, or is wider, and then the second one lives vertically. And you can see that here in the kind of the mint color that's highlighted. They're all kind of blended together with the townhomes, condos, and single family homes. Community also has a community center called The Deck with a pool, spa, community room, which helps overcome those smaller lot sizes. Now here's the one detached home. And I think when you walk communities on a regular basis, anything different really stands out. And I think that's true for a home buyer as well. So if they're shopping in a particular area and they're typically seeing the same thing over and over again, this product or this floor plan in particular was really different. And I was like, wow, this I've never been in a house like this. And it has a lot of windows up front, so it brings in a lot of light. The kitchen is set back, but it's associates closely with their outdoor room and yard. Has a bedroom down. I think this is a roughly 3,000 square foot home on a lot that's, I believe, less than 4,000 square feet. So let's go into the San Diego market. Again, 3.4 million residents, 1.2 households. So it's the smallest market in the group. Unemployment is down to 2.9%. It's probably the lowest in Southern California. Again, we're not heavily tied to employment. It's important, but not a key driver. And starts are exceeding. This is the one market that's a little different. Starts are exceeding closings currently. But again, the marketplace in terms of active projects is low, and you can see that correction that's occurring. So I don't see this as any sort of problem area for the marketplace, especially considering that we've gone from nearly 150 communities down to about 60. And you can see on the map, they're all pretty geographically distributed. There are 3 or 4 master plan communities here. So there are little concentrations, but overall market-wide, there isn't a ton of head-to-head competition in this marketplace. Again, I mentioned earlier, the trending isn't always readily apparent in the San Diego marketplace just from what's available for sale from one month to the next. Sales rates, like the balance of the market, are really hovering in that 2.5 to 3 per month range. Moving forward, I'm guessing it'll bounce. I don't see it going back up to 4. There may be select communities that do that, but from a market perspective, I think the 2.5, 3 per month is kind of where we're going to be at moving forward, at least for the next 12 to 18 months. QMI, out of all the markets, San Diego has the lowest QMI inventory available in the marketplace, and I think that's probably one of the reasons why we kind of had that little spike in starts. to kind of bring more inventory back into the marketplace, but there's only one unit on average per project of quick move-in inventory. So really the lowest in the marketplace. What's interesting here is, you know, our median San Diego County sales price in the resale market has really diminished to about 850 in January so far. What's interesting is that the asking price for that group of home sales was the highest that it's been since last summer. So the prices of the homes sold were much higher than typical over the last, let's say, 3 to 4 months. And I think that largely has to do with the fact that they've probably been sitting on the marketplace. If they were still available in December for sale, they really wanted to sell, and buyers were starting to get deals. Again, days on market, 20 is the median days on market. So half selling above, half selling below, or quicker than that. Nothing out of the ordinary for this market. And as Ali mentioned, expired listings definitely spiking in December. We were seeing some listings come off the market. It helps with their days on market, kind of comes back fresh at the end, which was more of a traditional marketplace. That's typically what's happened in a December situation, is the realtors will recommend buyers take off their listing, relist it early in the month or early in the year to get those shoppers in the spring selling season. Again, we're going to have a trend here. Lennar is the top builder, 28% market share, average sales rate of 4.1. TriPoint Shea builds in several communities with Lennar, so they're also one of the top builders. All top 3 have an average sales price or asking price over $1 million. What's interesting here is in order to land on the top 10 list, so if you look at 7 through 10, they only have one active community in San Diego County right now, but they're still a top builder. Now, I was originally going to highlight a different community for San Diego, but when I looked at the sales rates, I noticed that overall, the South County has some of the fastest selling communities in San Diego right now. So if you look at Cordovera, which is Shea and Lennar, they're building townhomes, 6 to 8 pack detached homes, and inline smaller lot Shea's community there at the bottom right. So all 3 of these are in the top 3 for sales pace overall in San Diego. And if you look at the 4th, it's also in South County by TriPoint. So I think the blend of proximity to downtown San Diego, the lack of new home supply in the South Bay marketplace really helps this community out. And it's kind of that roadmap of kind of where the demand is. You know, you need a desirable community close to shopping and schools and also work, which are those items that Ali highlighted earlier. Riverside San Bernardino, this is the last. I'm in the home stretch now. I know we don't have much time left, but Riverside San Bernardino, 4.7 million residents, 1.5 million households. Historically, has been a bedroom community for both or all coastal counties, LA, San Diego, and Orange County. There is big growth in logistics, healthcare, and the government sectors in Riverside County. We're definitely seeing this market mature, and we're seeing a lot more employment located within the boundaries of the Inland Empire. So while there's still a siphoning of demand from the coastal markets, we're definitely seeing an increase in more local and more locally employed buyers in Riverside and San Bernardino County. Now, I mentioned the increase in logistics. This is a map of the logistics development over the past 10 years. You can see that anywhere from Amazon, Target, you know, most major retailers have distribution centers here in the Inland Empire now. It's only growing. There's going to be more definitely in the Beaumont Banning area out into the desert as well. But again, a lot of employment growth, and we have some home prices that these workers can afford, at least if they're dual income. Starts, again, situation where starts are lagging closings, relatively balanced. We don't have a big concern for overbuilding here at this point. Now, of the markets, the lowest, there's the most land supply in Riverside, San Bernardino, so we've had the lowest change in the number of active communities. But again, as you can see, in terms of pricing, we're more affordable in the Inland Empire than most of the Southern California region. In terms of sales, much like the balance of the market, you can see we've really just, as a market overall, have really headed to that 2.5 to 3 sales per month band. There was a large drawback in the marketplace. People didn't want to buy at the top. And so just this cumulative effect of everybody pulling back and waiting, it really caused that decline. And it was a really rapid decline. Good news is it's trending back up again. Those incentives seem to be working, pulling buyers out, and those lower interest rates as well. So hopefully we can get those lower interest rates to stick, and some more confidence in the home building market from a consumer standpoint. Quick move-ins, the highest number of quick move-ins overall, but again, we're only talking about 1.6 quick move-ins per new home community. So not incredibly high, and actually it has improved over the last 3 months. The resale market, much like everything, all the other markets, we're talking about a change of about 10 to 20% typically in terms of pricing. The sales prices are typically at 92 to 95% of asking, depending on the county. Days on market tends to be a little bit higher. Again, we have more inventory from not only from a new home perspective, but also from a resale perspective as well. So there's greater choice. Buyers are definitely out there shopping. They're going to look at everything and try to find the best deal possible in today's market. Vacant developed lots, we're at the highest number of vacant developed lots in the area, but unsurprising given the size of the market. At 15 months of supply, seriously, we're not oversupplied in the least. And so I think there's a good balance there. It's the fighting for the buyers at this point that is the concern for most home builders. And surprise, Lennar is at the top again. So pretty much 20% market share in every market in Southern California. They build in pretty much every market in Riverside County, from out to the desert, up to Fontana in the north, and down through the Menifee, Temecula area as well. So the top 5 publics, all very active in the marketplace. I will note that for this marketplace, Horton and Pulte are building under Centex and Horton Express, which aren't included in these numbers. So their numbers are actually a little bit higher than represented on the chart. But average prices, you can get a new home for about half the price you can in a coastal market. And what I'm getting a lot of questions on moving forward is, hey, the senior market is cash equity rich, less sensitive to interest rates. Should we be building senior communities? And while I agree with the concept, I think the time to develop an active adult community, getting to know the space, and developing it is another matter, because that timeline is going to take you so far out. So I thought I'd highlight Del Webb, because when we look at the senior communities, yes, there are some that are performing well and just basically selling at the same pace they have for the last for 4 years. There are others that have slowed down pretty dramatically. So you still have to have the right combination of location and amenities and product execution. So Del Webb's been active in Rancho Mirage since 2018. They're nearing completion of this project. Is about 1,000 units. Overall, it's sold about 18 units a month. So you're talking about on average 6 units for each one of these product lines. So very successful project here. Disney has a storybook living community very close to this community that has started development. And we expect to see that on the horizon here in the next year or two. So what does the Southern California look like moving forward? I know I'm a minute over. I'm going to try to speed up here. We're discovering the new normal. While our overall stats are pointing to normalizing market condition, the reality of slower sales, price impacts, higher incentives are really a big hit to developers, and it's hard to kind of figure out the market and where we're going. Land constraints will help fortify that price floor. We talked about that quite a bit. Future supply is really concentrated in select locations. So, it may be better opportunities to go look for some infill parcels that may have been overlooked in the last cycle or the pandemic cycle. Our net migration is actually forecasted to be negative for the next couple of years. Everybody's talking about California losing population. We have a very large population base, and net migration has really been negative for a number of years. So it's not really a key driver in our housing demand. So those headlines can largely be ignored, at least for now. Affordability is front and center. Buyers are expecting, maybe a little bit of a price decline, but they really want the incentives and they want that lower interest rate. The problem and the challenge for us in Southern California is that while in other parts of the country, you can do a buy down to a fixed rate, our prices are so high that the price of that discount to a fixed rate is so high, it's prohibitive. So for most of our builders, we're offering 2-1 buy downs rather than a 30-year fixed. Great for some, or worth the risk for some, but others may want that, would prefer that locked-in rate fixed. And then just moving forward, expect mixed indicators. January's looking good. We're going to have some positive news to report, but at the same time, with the potential, government shutdown, there's interest rates. We never know what they're going to be doing. So we're just going to see ups and downs this year moving forward. We just have to roll with the punches, keep our chins up and move forward. So with that, I am going to conclude. Thank you very much for joining us. There's 3 things I need to tell you. We're going to automatically send out the recording and the slides within a day. If you're interested in any more of our webinars, economic reports, or podcasts, please scan the QR code and you'll get notified of those. And please stick around for the end. There's a survey. You can give us feedback and tell me not to go over next time. And with that, I wish you all a very happy and healthy 2023. Thank you.